Hello, everybody. Ralph Russell, Springboard Funding Partners, and happy to have with me here Brian Goodwin with Incentax. And Brian is an expert in the employee retention tax credit. Been getting a lot of calls and emails about this topic. It's a fantastic program for business owners. So, Brian, first of all, thanks for your time today, and look forward to diving into this.
Yeah. Thanks for having me.
Absolutely. So let's begin with a concise description of what the employee retention tax credit is.
Yeah, so it's one of those things that there's still not a lot of information that has been read. There's a lot of information out there, but this is one of those IRS tax credits that the IRS doesn't do a great job of telling everybody is out there. But ultimately what this is, the employee retention credit is a credit from the government that is designed to help businesses who were negatively affected by COVID-19. Now, everybody's probably going to say, well, that's probably me, right? Because every business was negatively affected. But there's going to be certain criteria revolving around certain levels of revenue declines or business suspensions that can get everybody qualified. And and one of the unique things with this is like kind of the understanding of where it came from, because there's a lot of people who think, oh, this just came out. Mm-hmm. Well, it actually goes into a lot of what goes into the whole process is to understand where it came from. And that is, it came out at the same time as the PPP loans came out in March of last year. But at the time they came out, you had to decide one or the other. You could not take both programs. So you had to pick. So the decision really came down to, do I want to get money now and take a PPP loan, or do I want to get money at the end of the year and take a credit? So nobody took the credit. Everybody went PPP loan. Well, so at the end of 2020, once Congress realized nobody had taken advantage of this, they changed the ruling. And so the new ruling, and this is the foundation of why this has become very open to many people, where before, if you had taken a PPP loan, you could not touch this. Now you can. So now you can have participated in PPP round 1 or 2, and now still take the employee retention credit. However, there just has to be a very nice hard line between the two.
Yeah, we'll get into that. I mean, since I met you back in March and started talking to clients and interested parties about the employee retention tax credit, so many business owners are kind of skeptical because they haven't heard much about it. And then when I become a little bit more in depth on the topic with them, they are just ready to jump at this because of the amazing tax refunds available and tax credits available with this program. So let's get into how much money a typical business owner can qualify for with the employee retention tax credit, not only for 2020, but all 4 quarters possibly for 2021 as well.
Yeah, absolutely. So the potential on this is pretty big. The credit comes in the form of a Social Security payroll tax credit. So that's the vehicle that's being used. It's a fully refundable credit, which basically means it doesn't matter the size of your liability that you paid in, they're going to pay out the excess. So it's a long way of saying whatever the credit amount is what your credit will be. So the potential, if somebody were able to max it out, all right, everything worked out and they could take care of everything to the max. So for 2020, there's a single study that would be retroactively looked at for 2020. The max amount is $5,000 per employee for the whole year. And then for 21's become a little bit more robust. You'll find that it's a little bit easier to qualify, but also it pays out a little bit more. So where 2020 was $5,000 for the whole year, 21 you can get up to $7,000 per quarter per employee. And so if you think about that per quarter, that means every single quarter there's a study throughout the year. So there's potential of $28,000 if somebody were to max out the qualification on a single employee for this year. So when you add all that up, there's really $33,000 of credit that's on the table, and then it just comes down to figuring out, to what level can somebody take advantage of that.
Yeah, and that's $33,000 per W-2 employee. And let's pivot for a quick second on that. That includes part-time employees as well, W-2 employees and full-time?
Yeah, it does, because this calculation goes into qualified wages, right? That's really one of the big things. And there's a max on qualified wages, so you can't pull more than $10,000 in any study period on a single employee. But you can pull any wage. So even if somebody came in and worked for a business for 2 weeks and earned $500, you can still pull that $500 into the calculation.
Wonderful. Okay, so when you look at how a company determines that they qualify for the employee retention tax credit, let's talk about that based on revenue in 2020 and 21, or let's you can kick it off from there. How does a company determine if they qualify for last year and this year?
Yeah, absolutely. So the first date that we can look at to see if somebody qualifies is going to be March 13th, 2020. And so that's our kickoff, and then we can go up to the current date, and we'll be able to go throughout the rest of the year. Now, each individual quarter, you can qualify or not qualify. And so each individual quarter has to find a qualifying event. Now, there's basically 3 ways to qualify. And one of the big things that gets people is they'll read through the qualification and they'll say, well, I had that, but this other one doesn't apply to me. And I hear that a lot. And one of the things I could really stress here is all you need in any individual quarter is just one qualification. It doesn't matter if you don't have to hit all 3, you don't have to hit 2, you just have to have one qualification to get it. So the qualifications start off from a revenue standpoint. So if we're looking at 2020, the way that somebody would qualify on revenue is if you look at gross receipts / gross revenues on a quarterly basis, and then you look at that quarter in 2020 and you compare it with the same quarter in 2019. If there was a 50% decline in any one of those quarters, then that's going to trigger the opportunity to be able to look at this, because that one quarter of 50% will make a person eligible for that quarter. But then it also opens up the ability to look at other quarters to pull in based on some of the rules. So ultimately, and you'll see in these revenue calculations, we're always going to be looking at 2019 as the base year, because that was the year prior to the pandemic. That's our benchmark. How were things before everything got weird?
Yeah, absolutely. So in 2020, if we're looking at revenue, just to recap, the revenue in the quarter in 2020 has to be 50%, 50 below the same quarter in 2019. And let's get into, if the revenue didn't drop that much, what's the second way they could qualify for the employee retention tax credit for 2020?
Yeah, so the other way that somebody can qualify, and this actually will go across the whole breadth of the available time that they can look at, is going to be on the idea of a business suspension. So this would read as if a business had their operations suspended due to a COVID-19 government order, then they would be qualified in the quarter in which that happens. Now, in order to think about this, this is one of those areas where, like, when we talk about revenue, it's cut and dry. You got a number, you either hit it or you didn't. With the business suspension, well, there's a piece of it that's cut and dry, right? Hey, were you closed and not able to operate at all? All right, then that's a full suspension.
Sure.
Now, the other area that has a little bit of it's a little bit gray is the idea of a partial suspension. And so I'll describe that a little bit. And the easiest way to do this is to talk about restaurants, because almost every restaurant that I've talked to is going to qualify for this. So if you think about it, the restaurants were told at some point, hey, close your doors, no business, right? That was a government order, came down from federal, state, local municipalities and said, you must shut your doors.
Sure.
Full shutdown. Got it. All right, so now that restaurant's been shut down for a couple of weeks, they open up, but they're being told by a government agency in a government order that they can only do takeout. They can only offer curbside service. Then they can only offer 50%. They can only have 50% of their capacity,
right.
And maybe it's 75%. Or maybe they're having to abide by social distancing rules, and because of that, they have to reduce the number of tables inside of their dining room, therefore limiting their capacity to serve people. So all of those are instances of a partial shutdown, because that government order has really limited them on how they can operate their business. And there's a lot of different variances to that, and that's where there's sometimes there's some interesting interpretations, and we have some interesting conversations with people as we try to dig into that. But that one would, like, that can happen in any single quarter from 2020 up until now.
Yeah, and I know just in the conversations we've had, the clients that I've collaborated with you on in your firm on this, there's definitely many ways for a limited shutdown, if you will, to be proven for 2020. Now we get into 2021. You mentioned this in your earlier comment. It's much easier for business to qualify for 2021 on a revenue basis compared to maybe 2020, because in 2021, and starting in Q1, revenues only have to be 20%. That's 2.0 below where they were in the first quarter of 19. Please, you can elaborate on 2021 rules and how it's much more, well, easier for companies to qualify in the revenue basis compared to 2020.
Yeah, and only having to hit that 20%, it actually makes this more achievable. The 50% can be tough for some people. Now, if they were shut down completely, that might be that one quarter where they can get it. So it is a little bit harder. So that 20% decline makes it a little bit more achievable. But the big thing to remember on this is that it is still looking at that 2019 Q1 as the comparison. So that's what gets missed a lot. Sometimes people think they have to look at 2020, and that does skew the numbers. Now with 2021, and with all of them, there's all these little specific rules. But one of the interesting ones about 21 is that if somebody qualifies in one quarter of 21, and I think this may apply to just the first two quarters, but then they'll automatically qualify for the second quarter. Right now, that's got to be based off of revenue, not off the business suspension. So there's people who, if they, maybe Q1 21 was their last quarter of being down. Now Q2, they're coming back strong. They're hiring more people. Revenues are growing. They'll still be eligible to take advantage of it because of that piece of the rule. And that's one of those things where if you read the rule and you say, hey, it's 50%, 20%, you either hit it or you don't, and you walk away. There's a lot of things that can get missed because some of those little intricacies of the law are the things that can actually really pay off if you dig into them.
And we'll talk about what your company does to uncover some of those intricacies and how you do everything you can to help each company try to obviously, one, qualify, and secondly, qualify for the max credit eligible. So you mentioned before we started taping this that there's some changes coming to the employee retention credit in the last couple of quarters of 2021. Let's discuss that.
Yeah, so some of them are minor changes, a little bit behind the scenes. One is this has been a Social Security tax credit up until this point. However, starting in Q3, this will turn into a Medicare tax credit. Now, for most people, that's not going to be a huge driver. But one thing to note is that's going to change how other credits react to this. So people who have taken advantage of the FFCRA, for the extended medical leave, R&D tax credits, FICA tip credit, these things, that's for your restaurants who get the FICA tip credit on the servers. These things all will get adjusted because now the credit is being pushed towards something else. Versus Social Security. So it is on the back end going to make some changes. Then there's another one that is coming into place, and this one's a little bit unique, and this is for the recovery startup businesses. So this program comes into place starting Q3, and this is for businesses who started during the pandemic. So if a business was started after February 15th, 2020, and they have less than $1 million of annual revenue, then they're going to automatically qualify for this in Q3 and Q4. So with zero qualification. So they don't have to have had lower revenues. They would not have to have had a business suspension. They simply will qualify for this based on being in existence and hitting some of those rules. Now, there's going to be ways to obviously tackle that, take advantage of that, and make sure it's done properly. But the max amount that one of those businesses can take advantage of, the max credit is $50,000. So for those new businesses, that's $100,000 of credit that they can get their hands on over the next 2 quarters. That I'm sure could be pretty big for them. And even with them, a lot of times they're probably still going to have retroactive studies that there's still credits that they'll be able to get from being open previously that they probably didn't even look at because they thought they couldn't qualify. So it might be a nice trigger to get people in to also do some retroactive studies to grab some additional credits from the past.
So we talk about the term credit, and a lot of people watching the video could think, well, that's something that my tax specialist needs to address. But the tax credit is really a form. It's coming in the form of a refund check from the IRS, and typically. When those credits are applied for, it's not necessarily a very intricate accounting measure. It's something that the client is receiving in the form of a check in the mail from the IRS. Once you obviously do the study, perform the work you need to do, and obviously prepare the proper paperwork to send the IRS, submit it to the IRS. IRS processes it, but then they explain to the viewers how the viewers actually get, or the business owners actually get the refund in the mail directly to their company.
Yeah. So like I said, each quarter is its own study.
Mm-hmm.
So the way to claim the money for each individual study, since it is a payroll tax credit, is by the amendment of a 941. So we take care of that for our clients. They don't have to worry about it. But the submission of that 941 and that 941 being received by the IRS, that's what claims the credit. So we get asked a lot, hey, has this been approved or not? The credit doesn't really get approved. It just has to be calculated correctly and then filled out correctly. Mm-hmm. Now, will it be audited one day is another question, but it doesn't have to be approved. It just needs to be done correctly. Now, once that is received, the IRS gets that and it comes out in the form of a refund and a refund check. Now, the big mystery is, hey, when are these checks coming out? Because the IRS is the IRS, and I don't think they're known for being the fastest group of people out there. I'd say right now, the guidance that I've heard lately, and who knows what the next one will be, is anywhere from 8 to 12 weeks for the delivery of that check. Now, one thing that is out there, and I think the IRS probably realized they were going to be slow at this, is, if somebody doesn't want to wait that long, because ultimately, what is this? This is COVID relief. This is money they want to get in the hands of business owners now. Yep. And, 12 weeks is not now.
Exactly.
So businesses do have the opportunity on their 2021 studies, once those are filed, and it's at least Q1 and Q2, once those are filed and the IRS has that amended 941, a business can access their credits early by reducing their payroll tax deposits that they would pay the IRS until they get their credit. So ultimately, if you think about it, the IRS is saying, hey, we owe you a bunch of money, but you're still paying us a bunch of money while you're waiting on us to pay you money. Why don't you just hold on to the money? Call it in advance. And then when you get your credit, just go ahead and pay us back. Ultimately, what they're doing is they're saying, hey, once you have filed this and you're due a credit, you hold on to your payroll tax money. We, as in the IRS, will not charge penalties and interest for late payroll tax deposits. You hold on to the money, you access it early, use it as an advance. And so that's one of the vehicles that people can use to do that. And honestly, that's where we found one of the areas we end up consulting a lot on is helping people understand that, because I think people are used to, I think if you tell somebody you don't have to pay the IRS, it scares them. Right. So, that additional guidance to understand that program so they can access their money quickly is a big benefit.
Excellent. So what documents do business owners need to provide your company in order to see if the company, for you to determine if the company qualifies for the employee tax credit?
Yeah, it's it's not too hard. It all depends on the reporting structure and platforms they use, but we'll need some detailed PPP information regarding forgiveness, amounts applied towards payroll, the dates, all that stuff. If revenues are in play, we're going to need financials, so that way we can evaluate what actually works. We'll need some maybe some documentation from them on business shutdowns. If they have anything that they have in their possession that says, hey, this is going to support the case. And then it just goes into a lot of payroll data. Right. Pulling the right payroll so that way we can pull the individual wages and see what goes into there. Because also health insurance costs that the companies pay can go in there as well.
Okay. And what is a typical turnaround time for you to determine if a company can qualify once you have all the documents requested?
Yeah, well, honestly, our process usually starts with a qualification call where we'll jump on and do a little bit of education and then dig into the qualification piece. And usually after that call, we can be anywhere from 90 to 100% sure of where somebody's going to stand. We may need just a little bit of extra info on whether or not they're actually going to qualify. And from there, it's just a matter of us getting the data from the client. Once we get the data we need, we've actually been able to speed up our process as we've been doing this just by adding in some extra technology. But 10 days to 2 weeks is our turnaround on most normal businesses. If somebody comes in with a giant business, give us a little bit of grace on that one.
Sure.
But for the most part, 10 days to 2 weeks from complete submission for us to have amended 941s back in place for multiple study periods.
Yeah, and I can speak from experience. When I first talk to clients about this particular program, and we get into it in a high level, discuss how they could qualify, just as we've discussed in this video here today, learn a little bit about their business, how it was impacted, if it's still being impacted, what the revenue drops have been. The next step is for me to arrange a call with Brian, and we then get into it more granularly, and then from that point, have a better idea if the company can qualify and to what extent. Now, what about people who are considering doing this, Brian? And again, we're speaking with Brian Goodwin of Incentex. What about people who are considering doing this themselves? Maybe they've heard about it somehow, some way, and they're like, I can do this. I don't need some professional's help. What are your thoughts there?
Yeah, it's one of those things where, on the surface you read it like, hey, this may not be too hard. And look, there may be a business or two out there that could have a very simple calculation. But I kind of look at this as if my car broke down. I could go out there and try to figure it out, probably bloody my knuckles, and in the end, I'll probably do it wrong and have to pay a bunch of money to go get somebody to do it right. And that's kind of the way I look at it this way. There's a lot of things that it's the nooks and crannies. That's kind of what I tell everybody. It's the things that you don't read on the big paragraph when you read an article, and it's all the little stuff that you've got to watch out for. For example, and we've audited some studies for people, and there's been, they've done it themselves, or maybe there's a payroll company that had done it. And, and one, it makes us appreciate our process of being thorough and asking all the questions we ask. But things that can't be on there, like you cannot count owners' wages, right? If an owner has more than 50% of ownership in a business and they're on payroll, well, we cannot count their wages. We cannot count their family members' wages. You've got the issue with double dipping on the ERC and the PPP wages, right? So making sure that everything matches up there. But then also there's sometimes there's an opportunity cost of somebody not filing their forgiveness using the best amounts, and they actually leave credits on the table because they weren't matching both programs. And then you're also just going to see when there's other stuff that's involved. So companies who take advantage of other programs need to be very aware of how this program matches up to that. So once again, restaurants who use the FICA tip credit, their FICA tip credit calculation is going to be crazy at the end of the year. So they're going to have to really make sure they're taking great notes on this, or be working with somebody who can do it, or like work opportunity tax credits, right? Work opportunity tax credit is a new hire credit. It's a great credit. It provides income tax credits for a business to hire certain employees of demographics. Demographics who are mainly people who might be coming off of some sort of government assistance, or you've got a veteran program wrapped up in there. Well, you can't double dip on that either. So you got all these little rules, right, based on what companies do that they've got to watch out for.
That's very interesting. Yeah, we'll talk about that some other time. We can do another video on some of those other credits, because I think business owners would love to learn about those as well. So, just a few examples I'll get into with my own clients, or a couple of industries, and then Brian, you can touch into some of yours as well. But I'm just going to talk broad-based here. Clients that have benefited from this program have been in the home healthcare business, legal office, doctor's office, a few restaurants, and locally here, church with a number of employees, not only in the church but in the school attached with the church. And so it's a really broad-based program available to many, many industries. In fact, the only industries that I've not been able to get the program available, the tax credits available for them, has been one gigantic liquor store who did really well during COVID, and also trucking companies who, as many people know, did really well during COVID because they had to move product, right? They had to move groceries, they had to move product. One of the few businesses Those are a few examples of the businesses that were just crushing it during COVID, but most businesses suffered, as everybody knows, and so most businesses will definitely qualify or should qualify for this program. But Brian, why don't you give us a few examples of your own that you've seen success with to date?
Yeah, so we get asked that question a lot, like, hey, what industries?
Mm-hmm.
Now, when it comes to revenue, I mean, revenue is revenue. It doesn't matter the industry. It doesn't matter why your revenue is less. If it's just revenue and it's a decline and it meets any one of those qualification criteria, then you qualify. Where you can really start to, I think dig into industries a little bit more is probably in that business suspension and that partial suspension. Mm-hmm. And this is that area where I think we've really been able to help a lot of people who probably had no clue they could actually participate. And from that standpoint, look, any restaurant in the United States who has not looked at this is missing money.
No doubt.
I mean, yeah, that is the number one business who should be looking at this. We've also found that a lot of your medical and dental offices, they're going to qualify on this as well. Because if you think about it, their business is based on people congregating in a small room, mm-hmm. And waiting on them, and they're not known for having the biggest offices, right? So we've talked to many of these providers who, they've shut down pieces of their office. They're not allowing people in their waiting room, mm-hmm. and it just once again lowers their capacity to do business. And somebody could be deemed an essential business and say, hey, you have to stay open, but they could still be affected by a partial shutdown. Mm-hmm. And so it's that piece of anybody who's got a walk-in component, mm-hmm. right, a physical component, mm-hmm. to the business, and they took a hit, right? And they feel like it was because of an order. This is something they should really explore. But yeah, just a couple examples. We had a restaurant with about 25, 30 employees. We got them close to $200,000. Mm-hmm. I think it was $70,000 for 2021, and then like another $98,000 on their 2020 study. We had a Popeyes franchise. He's got 3 locations, and he got close to almost $600,000 because he had 90 employees.
Fantastic.
And then from the dentist standpoint, this one's kind of a little more on the smaller end of where we'll handle. Mm-hmm. They had about 6 or 7 employees, mm-hmm. But altogether through 2 study periods, we were still able to help them with about $70,000 of credit.
Yeah, that was my next question is there a minimum number of W-2 employees a company can have to qualify?
Yeah, so, I mean, as far as a company qualifying, I mean, all a company needs to have is 1 W-2 employee. Mm-hmm. If you are a business owner and you've paid in payroll taxes on an employee that is not yourself as a 50% mm-hmm. owner and not one of your family members, mm-hmm. then you can qualify. Now, for us as a consulting firm, we generally would look for people who have 5 to 10 employees for us to be able to help them out, just so it makes sense for all involved. Because obviously we would have costs to do it, and we don't want to have them pay out the more than what their benefit's going to be. So for us personally, 5 to 10 employees, but anybody who has a W-2 employee is eligible for this.
Great. Just a couple more questions here. What's the average cost to the business owner to work with your firm on the employee tax credit?
Yeah. So a little bit of what we do, we're a full service consulting firm. So we do everything from qualification, exploration of the data, finding out what's eligible, ineligible, final calculation, produce the 941s, and then we consult with them on how to access the money early in the ERC. We charge based on the scope of the project. We do not charge anything up front. So if we do a study for somebody and they are not eligible, they'll never pay us a fee. Mm-hmm. Otherwise, our fee will range anywhere from 10 to 20% based on the scope of the project. And that's 10 to 20% of whatever the credit is found.
Mm-hmm. Which I think is fantastic. Now, you shared some great reasons why a business should turn to you for help with the ERC. Is there anything else that you'd like to add?
One of the biggest things that, and I mentioned this earlier, it's not that the credit has to be turned in and approved. So you can turn in an inaccurate study. Mm-hmm. And you'll get money, right? You'll get credit for it.
Right.
But one of the things that I think people need to make sure they're understanding is the IRS has expanded the normal 3-year term to be able to go back and evaluate claims, and they've made this a 5-year term. All right, so that's 5 years the IRS is putting out there to be able to go back and check for documentation and make sure this is right. Because look, there's a lot of people who are getting tens or hundreds of thousands of dollars, and there's likely to be a point where the IRS says, hey, let's just go make sure this was done right. And that's going to be the point where people are going to want to make sure that they've really hit all the nooks and crannies, dotted the I's, crossed the T's, and that they've got a great record and they've built a great case that allows them to tell the IRS, here you go. And so that's one of the things we do is we're just helping to build that case to protect people so that way they don't have the IRS issues down the road.
And just to summarize too, I mean, so now that this is being filmed around June 19th, so we're nearing the end of the second quarter. So if companies have not looked into this program as of yet, the Employee Retention Tax Credit, and wish to schedule a call, which we'll get into here in a couple minutes, but your company will be able to look at whether they qualify for 2020 as well as for Q1 2021 and Q2 of 2021. I just want to once again really drive that home, because the 2020 credit is $5,000, up to $5,000 per eligible W-2 employee for the entire year. But 2021, it's up to $7,000 per W-2 qualified employee for every single quarter that you could qualify for. So, again, this is a time to really take a look at this and get engaged in it, because you could be seeing a substantial refund back or credit back. As I said, Brian and his company Incentex have helped a lot of my clients with this. They've got some substantial money back for 2020 and Q1 of 21. And again, I'm sure they'll be itching to get you started on Q2 as well to see what they're going to qualify for Q2. So it's an exciting time to get involved in this. And then, so how can someone reach out for help? Well, obviously, this video will be available both on my website and also on my YouTube page. But so people will have a link on those on my site as well as YouTube to obviously schedule a call with both of us. But any other thoughts on how to reach out to you?
Yeah, I really appreciate the opportunity to come on here and talk with you about this, Ralph. Our partnership's been great, and I look forward to what we're what we're going to be able to continue to do to help people out.
Likewise.
And and all I would ask is anyone else who is is open to talking to us and having Ralph and I participate. There's going to be a link that we'll send out that will make sure is available. And on there, you can submit your information. You can actually go in and submit a time to schedule a call. So it's very easy to go in and do that. Just if anybody introduces you to this, just make sure that you put who that person is. There's a spot on that page of who introduced you, because we always like to appreciate the people who are helping us out as well. So yeah, make sure you put that down would be the number one thing. But yeah, we'll get that information out there.
Great, wonderful. Well, you guys do a great job. I really do appreciate it. We'll talk some more about other tax credit programs that you help clients with across the country. And this is a program available for people all over the country. So whether you're watching this in Washington State all the way down to Florida and every state in between, you can definitely look into whether you can qualify or not. So again, Brian, many thanks. Continued success with the program, and look forward to staying in touch down the road and bringing you more clients that can hopefully really get some value out of this. So continued success, and we'll talk soon.
Awesome. Thanks, Ralph. I appreciate it.
You got it. Bye-bye.